Brian, thank you very much. Minutes to the December meeting showed the rate cut that the Fed, the 25 basis point rate cut, was maybe a closer call than it appeared from the vote, which was 9 in favor of the cut, 2 dissenting against it, and 1 for a 50 basis point cut. The minutes show that a few of those who voted for the cut said they could have supported no change at all, and some wanted to wait for more data. Remember, the government was still they were still getting data from the closed government period there. Inflation risk was seen tilted to the upside, labor market risk to the downside, and what you're going to hear now is a debate between those two sides. Some care more about inflation, others more about employment. Those supporting the cut said it was in line with forecasts for future lower inflation. Now, the committee did appear to agree on the need for future cuts. The debate was about the timing of future cuts. Most judged further rate cuts appropriate if inflation declined over time as expected. Some, however, wanted to keep rates unchanged, quote, for some time to assess the impact of recent cuts they'd already done. Others argued a move to a more neutral policy would help forestall what they were concerned about, a, quote, major deterioration in labor market conditions, to forestall that. Many saw a low probability that tariffs would lead to persistent inflation. That concern about tariffs was diminishing there. Several were concerned, however, that higher inflation would become entrenched. If it feels like I'm going back and forth, it's because that's the way the minutes read. Many expected tariff inflation to wane, but debated when and by how much. Some saw persistent price pressures, however, unrelated to tariffs. The majority of participants noted that inflation is above target for some time and had not moved closer, and some were concerned that the idea of the Fed not being at target would become entrenched and the commitment to the 2% target would be undermined by that. The labor market was seen continuing to soften, but stabilizing next year with appropriate policy. Now, this is a couple interesting facts that we keep talking about on CNBC. When you read the minutes, you see that the Fed itself is seeing this K-shaped economy with strong spending by higher income households, while lower income households are making, quote, adjustments for inflation. And a number were hopeful that higher productivity, possibly reflecting AI, could boost growth without inflation, however, also dampen job creation. So, Brian, I wish I could be more concise about how the committee felt, but the committee's feelings were literally all over the place, Brian.
Yeah, you and I have been doing this for a long time. Steve, normally, to your point, I think it's pretty concise and clear. Here's how we feel. It does feel the last few months, and with these minutes in particular, that we know there's dissents. I mean, there's been dissension, literally dissents, but it does feel like it's just a little more loose or a little harder to understand. What am I looking for here?
I think you're hitting it right on the head there, Brian. Let's layer in a couple things here. One, we had the government shut down. You had the cutoff, essentially, of official data, the data the Fed relies upon. I think that's a backdrop for this whole debate that's probably very important on both sides. You also have this idea that you have these tariffs of uncertain inflation effects that are going to come through. You did have the alternative data showing a weakening in the job market. So I guess, Brian, you remember that phrase? I forget who thought it up, but I thought maybe I did. But if you're not confused, you're not paying attention. Well, the Fed is paying attention to all of this, and I think collectively they're confused. But some are going to side more on the idea of, hey, we need to really worry about the job market, and others are saying, you know what? For 5 years, we've been above target. We need to get this inflation problem under control.
And there's going to be people that go after the Fed for being confused. I will actually be a little more gentile. It's near the end of the year. I can be nice, right? Why not? And it is a confusing time with tariffs and inflation and AI. We don't know what exactly is going to happen. And I actually don't blame the Fed. I would rather have them say, we're not quite sure, versus be like, we're darn sure, and then have it be darn wrong.
You know what, Brian? You're saying this makes me think of one of the things that you do as a hobby, which is to drive race cars, if I'm not mistaken. If you're driving a race car, you need to think about where the race car is going to be in 3 seconds from now because you're traveling at, 200 miles an hour. If you're driving an oil tanker, you don't have to make those decisions. You have to make those decisions earlier because it turns later, but the future is well in front of you if you're going much slower. And I think the situation right now is some on the Fed say, hey, let's take our time. We've cut 175. Let's chill out, take a look at where things are going. And there's a bunch of other folks that say, you know what? We have weak jobs in front of us now, and we're going to take a flyer, by the way, on where the car is going to be, which is higher productivity because of AI and lower inflation because tariffs are not going to come through. It's a bit of a debate about what kind of vehicle you're driving, sir.